Hey everyone, and welcome. In this video, we're going to unpack the online and digital-first fashion platforms block, the part of the fashion world where online and digital channels are the core of the business, not just a side project. We'll walk through what sits inside this block, how the business models and economics work, who the customers are, how macro cycles affect them, what has changed in the last 3 to 5 years, and how the future might play out under different scenarios. The aim is simple, to give you a clear end-to-end view of this block, so that, as a beginner or retail investor, you understand how it works before you ever look at individual stocks. Let's start by making sure we're clear on what exactly this block is and who sits inside it. Online and digital-first fashion platforms are businesses where the website or app is the main store. This is not a side channel. This is the core of the business. Inside this block, you'll find digital native direct-to-consumer brands selling mainly through their own sites and apps, online fashion marketplaces where many brands and sellers list products, resale and second-hand platforms focused on used clothes, bags, and shoes, rental and subscription services where you pay monthly to access a rotating wardrobe for parties, work, or luxury events, and broad e-commerce platforms where fashion is one of the biggest categories. So you can think of this block as the online front door for many different fashion formats: own brand DTC, multi-brand marketplaces, resale, rental, and big generalist platforms where fashion is a core category. What do these platforms actually sell, and where do they sit in the value chain? They mostly sell physical products: apparel, footwear, bags, accessories, and sometimes beauty, plus services and experiences like styling services, curated boxes with human or AI stylists, rental access, and authentication and consignment for luxury resale. On top of that, they sell digital services to brands and sellers, marketplace access, advertising and sponsored listings, and fulfillment and logistics for third-party sellers. The main customers are end consumers, everyone from budget shoppers to high-end luxury buyers, and small and mid-sized brands and sellers who use these platforms to reach customers and pay commissions, ad fees, and logistics fees. Governments are not really in the picture here. It's almost entirely consumer and merchant focused. In the value chain, these platforms sit downstream, close to the end customer, but they are also infrastructure for brands and small sellers. They sit between the brand or manufacturer and the consumer, owning demand, data, and the user interface. So they combine elements of distribution, retail, and digital infrastructure. Now let's look at the landscape and some example models, purely as illustrations, not stock calls. You'll recognize some illustrative listed names in this space. Again, these are not stock recommendations, just examples of models. Revolve, REVLV, Stitch Fix, SFIX, Rent the Runway, RENT, ThredUp, THRUD, The Real Real, REAL, Zalando, ZALD, ASOS, ASOS, Boohoo, BOOH, Farfetch, historically FTCH, and PDD Holdings with Temu, PDD. Alongside these, there are challenger models like Shein, which uses real-time demand data, a massive supplier network, and very small initial batches to test thousands of styles and scale only the winners. It's mobile-first, social media-driven, ultra-low price, and very cross-border, but it also attracts regulatory and ESG scrutiny. And there are rent and resale platforms such as ThredUp, The Real Real, and Vinted, which push a use and circulate model with circular fashion, authentication, and community. So that's the landscape, a mix of DTC brands, marketplaces, resale, rental, and ultra-value cross-border platforms, all sitting between brands and shoppers. Most online fashion platforms don't rely on just one model. They typically mix several revenue streams.
First, the retail or inventory model, often called 1P. Here, the platform buys inventory from brands or creates its own private label, then sells to consumers at a retail margin, like a store but online. Typical fashion gross margins are around 35 to 45% on inventory, but the platform takes inventory risk and bears returns and markdowns. Second, the marketplace or commission model, often called 3P. Third-party sellers list products, and the platform earns a take rate, often around 10 to 25% of GMV in fashion, plus payment and fulfillment fees. This model has lower inventory risk and is more scalable, but commission rates are heavily competed. Third, there are subscription and rental models, monthly fees for a rental wardrobe or styling services. Revenue visibility is higher, but the asset intensity can be higher too because of the rental inventory. Fourth, we have advertising and other services, sponsored listings, brand marketing campaigns, data insights, and logistics and fulfillment services sold to marketplace sellers. These can be high-margin add-ons when the platform has enough scale. Most large players combine all of these and over time shift more toward marketplace and services to improve capital efficiency. Now let's link those models to the underlying economics and key drivers. Capital is tied up in inventory for 1P and rental models, in tech and product development, software, data infrastructure, recommendation engines, search and app UX, and in logistics and fulfillment, warehouses, automation, packaging, and returns handling. A lot of money also goes into brand and customer acquisition via performance marketing, influencers, and social media content. Even asset-like marketplaces still need heavy working capital for marketing and tech. Economically, margins and returns are driven by order economics, basket size, gross margin percentage, shipping and returns cost per order, and marketing spend per order. Customer lifetime value, or LTV, how often customers buy, how long they stay active, and whether margins improve as loyalty grows. Operating leverage, tech and central costs scale with volume, so once a base is built, more GMV can drop through to profit. Returns rates, which can be extremely high, often 30 to 50% in some European online fashion markets, and can destroy margins if not managed. And the mix of business models. More marketplace and ad revenue usually means higher margins, while more 1P inventory means higher risk. Key drivers include online fashion penetration and e-commerce growth, the balance of customer acquisition cost versus lifetime value, logistics and fulfillment efficiency, regulation and cross-border rules, and technology and personalization, for example, better recommendation engines, size prediction, and AI-driven merchandising. Let's zoom in on the customer and spending side. The core customer here is the individual consumer buying clothing, footwear, and accessories for everyday wear, occasions like weddings and festivals, and for status and self-expression. Think sneakerheads, luxury buyers, and streetwear fans. Younger shoppers from late teens to 30s are usually overrepresented online, but older age groups are steadily catching up. In terms of frequency, active online fashion customers might buy a few times a year at the low end or several times a month at the high engagement end. It depends on income, lifestyle, and how fashion sensitive they are. Stickiness comes from saved preferences and size profiles, wish lists, loyalty programs, free shipping thresholds, and fast delivery, plus past positive experiences, on-time delivery, reliable sizing, and painless returns. If the app is on the phone and works well, behavior can become quite sticky, although many people still price compare on big purchases. Average order value varies by model. Value and fast fashion platforms often see $30 to $60 per order. Mid-market multi-brand platforms often see $60 to $120 per order. Luxury platforms can reach several $100s or more per order. On the margin side, 1P retail models might see 35 to 45% gross margin before shipping and returns. Marketplace commissions might yield 10 to 25% effective margin on GMV. After fulfillment, returns, and marketing, contribution margin for healthy players is often in the single to low double-digit percentages, while many early-stage or aggressive growth players run near break-even or negative as they scale. Globally, e-commerce penetration of apparel has been rising steadily, and the number of online fashion shoppers is still growing, especially in Asia, Latin America, the Middle East, and Africa. In mature markets like the US and Western Europe, user growth is slower. Most adults already shop online at least occasionally, so growth comes more from higher frequency, higher basket size, and share gains from weaker offline retailers. On screen, you can see a chart of online share of apparel by region over time, showing that steady climb, especially in emerging markets. Now let's connect customer choice, cyclicality, and behavior. Customers usually have a lot of choice: multiple large generalist platforms, specialist online boutiques, branded DTC sites and apps, offline stores, and off-price channels. In emerging markets, competition is intensifying quickly as regional platforms and cross-border players expand. That means low switching costs in theory, but strong platforms fight back with loyalty programs, faster delivery, better service, and exclusive or private label products. Online fashion platforms are clearly discretionary and cyclical. Basic clothing and footwear spend is relatively stable, but fashion and impulse purchases are easy to cut. In downturns, people can delay purchases or trade down to cheaper platforms and brands. At the same time, online platforms can still gain share from offline as shoppers hunt for deals and convenience. So they are cyclical versus the overall market, but sometimes more defensive than offline fashion retailers because of the channel shift. Behaviorally, fashion is largely discretionary, and customers are highly promotion sensitive, trained by constant discounts and flash sales, which can erode margins and brand equity over time. Switching is easy, but good experiences, loyalty points, convenient returns, and saved profiles limit real-world switching for regular shoppers. Social and influencer impact is crucial. Social media trends can rapidly drive traffic to platforms that host viral products or collaborations, leading to short bursts of demand. Those bursts are profitable if inventory and fulfillment can keep up, but risky if platforms overorder. Over the last 3 to 5 years, this space has changed fast. On the customer side, shopping has become mobile first and app first. Many people now buy directly through apps, social feeds, or live streams. Gen Z in particular expects fast delivery, easy returns, and almost no friction at checkout. They're also more open to resale and rental and are strongly influenced by short-form video and micro-influencers. On the business side, platforms have shifted toward marketplace models, combining their own sales with third-party sellers. Advertising and sponsored listings are now major profit drivers, and influencer and creator programs have become standard. At the same time, ultra-fast cross-border players like Shein and Temu have expanded rapidly, pushing prices down but attracting more regulatory scrutiny. Technology has improved recommendations, virtual try-ons, and warehouse automation, while regulation has tightened around labor, sustainability, product quality, and consumer rights. Overall, power has shifted toward data-rich platforms and strong brands, while smaller sellers and manufacturers face intense price pressure and thinner margins. Looking ahead, in the near term, online remains central to fashion shopping, especially for younger consumers. Apps and social commerce dominate, but high returns, heavy promotions, and intense competition continue to pressure margins. we're likely to see weaker pure-play platforms slow down or consolidate, while marketplaces, cross-border value players, resale models, and early AI personalization keep expanding. In the medium term, digital-first platforms remain core globally, with online share rising further, especially in emerging markets. Scale in logistics, data, and advertising becomes even more important, pushing consolidation and squeezing undifferentiated mid-size players. Growth stays ahead of the overall apparel market, though mature regions slow. In the long term, fashion stays a taste-driven category with digital discovery at the center. Margins remain thin, competition intense, but personalization, creator-led models, and circular ecosystems deepen, and regulation rewards platforms investing early in sustainability and traceability. For investors, the bull case is rising incomes, lower returns costs, and expanding marketplace and ad revenues. The base case is steady GDP-like growth with intense competition. The bear case is weak demand, higher costs, and margin pressure forcing consolidation. Bottom line, this sector stays essential but competitive. Returns depend on backing platforms with real scale, data, and resilient economics across all scenarios.